day everyone, and welcome to the Friday edition of the Premium Video Newsletter. What a wild week we had. I promised you a lot of volatility and the markets delivered. Unfortunately, volatility was in both directions, and we saw a lot of choppy market action and a lot of emotions in the market this past week. There was no fundamentals today, and honestly speaking, even if we had fundamentals, the market is still recovering from the volatility we saw earlier in the week to be impacted by news at this point. It will probably take another few days for the reaction of the FOMC to fade and for the market to once again react to daily fundamentals. Sometimes being right is not the best thing, and in this case, I wish it wasn't the case. I like seeing the market break out to new highs, but we always have to consider why this is happening. In this particular case, we rally because the Feds are going to continue to put a bandage on the economy. And what they hope will happen is with time, the economy will be able to stand on its own. The problem with the announcement was it didn't give us anything that suggests that the market is in fact strong. It reaffirmed that the US is still in a bad financial situation. Otherwise, the Feds wouldn't be helping us. So how much strength can be behind a move that's based on weakness? That's the question. In my opinion, and I will repeat what I said earlier in the week, but the buying was an overreaction. And now traders who overreacted and bought are panicking and liquidating their positions. The next level is going to be the 1700 level. And this is where the moving average happens to be at. Since the selling in the stock market was fairly broad-based, I will analyze other markets to see if we can find some consistency in what's happening with the stock market. If you recall, I mentioned yesterday that bonds typically move around in a very choppy fashion. Therefore, don't expect the bonds to come right down. The fact that today we saw a lower low suggests that we're going back to the 124 level sooner than later. We're still showing divergence between the bond market and the RSI indicator. And remember, markets price things ahead of time. So the fact that we already know that there will be a reduction in the stimuli will cause the market to slowly price this in. And that means lower bond prices and higher interest rates. I'm anticipating a bit more of a fight to keep the upside price levels. But within a week or so, I fully anticipate to see the bonds give up the fight and retrace back to the 124 level, and maybe even a bit lower. The next market I'm also seeing following the same pattern we're seeing in the bond market and the stock market is the US dollar. We're coming off oversold levels, and we have an RSI hook to the upside. The highs are getting higher, and I'm anticipating that we will see the 81 or maybe the 81.50 level within the next week or so. The dollar was really oversold over the FOMC, and it seems like it's gaining a bit more confidence back to the upside. Typically, it takes 3 to 5 trading days for the market to return back to equilibrium from aggressive buying or selling, and this is what the dollar is doing at this time. I want to look at the crude oil market since we haven't really analyzed it in some time. We had a fairly symmetrical triangle that began to break to the downside as we anticipated that it would. Syria didn't pan out, so now the symmetrical triangle is a downslope or a bearish triangle. And it looks like it wants to break out to the downside. Right now, we're not hearing too much about Syria, and if things stay that way for a few more days, I think the fundamentals are going to become more and more important once again. We have to see how strong the breakdown will be. If we can pass the 102 or the 101 level on the downside, we may see some real selling pressure. But till we get down to these levels, which can take a bit of time, we will most likely continue to drift randomly for the next few sessions, so the triangle may continue getting tighter. The pound continued to sell off today, and while we didn't see any more wild volatility, we did see a slowdown in trading action and a lower low today. For the next few sessions, I expect more drifting down and possibly a real slide once we get down past a bit the 159 level. We're coming off overbought area right now, so I'm expecting very little upside for the next several sessions. If the selling begins, it may accelerate because we rallied for a long time and we're really overbought at these levels. Watch the 159 level and let's see what happens after we get there. This market's got some downside and it's going to get interesting if we start breaking down. The next market I'd like to look at is the Canadian dollar. We haven't looked at the Canadian for a while because we've been busy with Syria and the FOMC. But the Canadian dollar is beginning to show signs of an overbought market. We have an island reversal and the RSI almost touched the 80 level, which is considered a red flag or overbought conditions. There's very little support in the Canadian dollar on the downside. If we break a bit more below the current level, there's a good chance we will come back down all the way down to the base. This is around the 95 level or even the 94 level and tells me that we may have a good swing down ahead of us. Watch the 96.5 area, and if you see a breakdown below that point, there's a really good chance we're headed down to the 94 level. There's a few setups for Monday that you may want to look at over the weekend. There's a tail gap to the downside on ticker SNY. Place a sell stop 20 cents below today's low. And if filled, place a buy stop 15 cents above today's high price. There's also a 4x4 to the downside, ticker symbol VSI. And this is a company I see everywhere called the Vitamin Shop. Place a sell stop once again 15 cents below today's low, and if filled, place a buy stop 15 cents above today's high. That's it for today's tutorial. I will update you on Monday morning and earlier if I see anything out of the ordinary. Have a great weekend, everyone.